I made more than 3% return this month trading my $50,000 account, but it didn't really feel good. Reality is I made some mistakes and some strategies like the volatility strategy really underperformed due to my product selection. So let me break down for you how month one went of trading a $50,000 account. So we can see here rate of return 3.19%. So right off the gate, my performance was pretty good. And the benchmark I'm competing against is the Nasdaq, the TQQQs. And I started the year with 51.4K. I'm finishing January with 53K. So yeah, 3.2% is a really great return in reality. If we annualize this, we are looking at close to 40% per year. It's great. However, the way that this return was achieved, I'm not really happy with it. In particular, these last few days, we can see there was a massive swing. Okay, so this is my trading log, and I will use it as a platform to discuss my different positions. Let's start with the strangles. This was really the loser of this month, and reality is this strategy is just not performing well. And I think there's a couple of reasons for that. Most of it is my fault. I didn't apply a good product selection, and we can see here what I've traded this year. Essentially, I have only losses with 2 break-evens. Mostly, it's related to the fact that they are commodities. And the reality and my main lesson from this month is to not trade commodities the same way that I trade stocks. The way I looked into this is at the end of December, there were very little opportunities on the stock side. Volatility was really compressed. And as volatility was compressed, I was looking for products that could keep my returns. The strangles were my best performing strategy of last year. And going into this year, I wanted to allocate more to strangles and I wanted to keep finding opportunities. But the reality is that performance is really poor. You can see here in 2026, I'm losing 1.29K in this strategy. So this is very significant performance. Like last year, I made about 3K with this strategy. So I'm estimating even if performing well, it will take a couple of months to recover on the strangle side. And the reality is that positions like SLV, UNG, and USO are all commodities that trade a little bit differently from stocks, and I try to trade them as stocks. And UNG and EQT are 2 related products. This is something that I completely overlooked. So EQT is a stock on the energy sector and is very related with the natural gas. So what happened here is that the natural gas at the dip at first, I brought down my strikes. The EQT at the dip as well, I also brought down my strikes, but then they rallied a lot over the last couple of weeks and it put me in a very severe loss. You can see that I was very close to my stop loss of $600 and I just closed this out when it was at about 20 days to expiration as I normally do. Going forward, I will mostly avoid commodities or I will decrease my allocation to commodities, and when I do trade commodities, I will not change my strikes like I do with stocks. Commodities have no circuit breakers. They can keep trending in one direction. They can get a lot of pressure. And then when they can invert really quickly and just change gears like it happened with silver really recently. It spiked up all the way to 110 and then it dropped 25% in one day. So commodities can trade really hard, and while the volatility risk premium is there, I need to decrease my allocation to them. So for this month, I just got into new positions and the system changed a little bit. Volatility has increased and I think there's good opportunities at this stage. I'm taking most of my capital in a position in IWM. So IWM has pretty good volatility. IVP is at 45%. I really like it here. So that's my main allocation in strangles for February. Then I have position in Delta Airlines, also good consolidation zone. So in terms of strangles, one of the positions I still have is USO. I know USO is a commodity, but reality is USO over the past 2 years has always traded in this range. The highest it has been is $92. The lowest it has been is $60. And we're looking back 4 years, we're looking back through a recession and a bull market. Right now, I can get a strangle in USO that covers up to 95 and down to 70. I'm pretty happy with that coverage, and it's paying really well on volatility side. So this is the only commodity that I'm owning into February. I have Delta Airlines. After earnings, Delta Airlines is stabilizing. Also, the range I'm getting between the 60s and the 77s and a half is pretty good. I have quite a wide margin here. I like Delta Airlines position. Volatility also is playing relatively well. And my biggest position in terms of volatility is definitely IWM. So when we look at IWM, it has been going up, but IWM volatility is paying really well for the type of product, the type of diversified fund it is. I'm very happy with IWM on the 45 IV percentile. The historic volatility has not been anything crazy, so at this stage I'm very happy with the stock volatility opportunities and these products into February. On the type of strategies that I call semi-directional, and if you don't know what my semi-directional strategies are, so check out this video where I break down my 3 types of strategies. Semi-directional in short are either short puts or the covered strangle. My short puts in January 2026 performed okay. I had very small amount of risk out. You can see that I only had 4 positions and most of them were really small tickers. They all turned into a profit, but nothing very meaningful. I made about $200 in these short puts over January. Right now I have a bunch of positions open, a little bit more than what I would like maybe. And maybe I would like to highlight that I have EOZ and ONDS, and I will be looking to close one of these positions. Even for a loss, I will close one of them on Monday. The reality is that they are 2 very speculative products at the same time. I don't really like that. It's bringing too much risk on my portfolio. For the rest of the positions, I'm happy owning and keeping them. I have XLF, financial sector, I have FXI, China, and I have Nvidia and Chromecast. Chromecast in specific, I would like to show. It just came off earnings. Earnings were pretty decent. Yeah, the long term is slightly going down, but it has been increasing since November. It has found its bottom, so I believe I have a stop loss at around 24 and a half, and I believe after these earnings, this will be a really safe play. And volatility, if we look, volatility is pretty decent, so it's returning about 2% in 19 days, so I'm very happy with this position. For the covered strangle, the only position I have is the triple Qs. So this is a leverage 3 times ETF. I have 200 shares of the triple Qs. My cost basis is at 52.8. Current price, if we look at the Qs, is at about 54. If we look in reality, over the past 5 months, the Qs has gone nowhere. So I've been able to profit a little bit from selling a short call and a short put. Whenever it moves up or down, I try to adjust my strikes, but reality is I've been able to collect pretty decent premium without any wild swings for the moment. Right now, I have position expiring next week with a 52 strike. I will see how this goes out. If I see that I'm getting risk to be assigned, I will roll this out in time to avoid the assignment and roll it down to collect some more and roll it down to decrease my risk. If not, I will let it expire and I will sell a new put to keep the ball rolling. On the short call side, my strike is the 59, so I have quite a bit of margin. So for now, I'll just collect that daily theta. I've made about $265 in this month. That's a 1% return on capital on my $25,000 allocation to this position. So that's a pretty decent return on the product that has not moved. On this position, I will learn a lot more if it starts rallying a little bit, as I have 200 shares but only 1 covered call. It means I have 100 shares that are uncovered, and that's the way that I'm gonna profit when this has the positive drift that long term it should have. So I talked about how the strangles and the volatility positions were really poor performers due to my stock selection. Well, the other side of the coin is my directional positions. My directional positions have been doing really great and I'm really happy with them. So in terms of closed positions, I have made about 1.5k, and the reality is most of the profits I have are from my directional positions. Also, most of the directional positions I currently have open have a significant profit, so I will update that as I close them. But I would like to highlight here FCX, that was a pretty good quick position that I had. NU is something that I have more long term, so I have LIPs that expire only January of next year. I'm very happy holding this position long term. I believe in NU is a stock I like for the long term. So in reality, what I've been doing is selling covered calls, but just rolling them out and up, and unlocking more profit potential. And you will have earnings in about 30 days. I will look to see how this plays out. But yeah, just happy to keep holding NU. It's showing a pretty decent profit, so we'll keep going with it. EM is another one that's showing a really decent profit. I bought this when it was down at 56.3. So if we look at EM right now, is at 59, is in a bit of a pullback. So, but I'm not really concerned with that pullback. I had a short call at 59.5, so I don't mind. I would like to see it hovering around the 59s for a while, and I can keep rolling out my short calls. EM is a diversified fund that has a lot of stocks inside I like SK Hynix or Samsung or Taiwan Semiconductors. So really happy to own EM long term. I have two plays for the downside on at this stage. One is HIMS and the other is RGTI. Both of them have been going down pretty meaningfully. So we see RGTI, I entered around here when it broke down from this level. This is a stock that has absolutely no earnings, it's just burning through cash. And when these things start to break down, I believe that this has no floor, it can just keep going down. So I entered in this position, and well, it's getting a pretty meaningful return in just a couple of days. And the other one is HIMS. HIMS has been on a long term downtrend. I entered around here, it stabilized, but it keeps going down. I was able to roll down my short put. So at the beginning, I entered with the 29.5 put, but then as it broke down below, I was able to roll out and still get some credit and got the 28.5. It's going to expire on Friday. Realities right now, HIMS is trading at 27, so I will have to manage this position going into this week. I will try to roll it down and out and see if I can collect some more premium and unlock a little bit more profit. If not, if I start to see that my short put and my long put start to have very similar deltas, I will just close this out to avoid any gamma effect like I had the problem with FCX. In my previous video of the week 2 review, I go into those details, so if you are interested, check it out. And last one that I want to talk about is AG. So AG, I entered in the 20th of January. It was really on a tear, so I entered it around here. And then you can see that it increased a lot, but then the collapse of silver that happened at the end of the month, this collapsed. Luckily, I was able to close it at the beginning of the day, so I was able to close it with a bit of profit, and I'm still considering how I should have played this out. Reality is I had a very meaningful profit when it was at around here, at around the 26. I unlocked by moving my 25 short call to the 27 short call, and at that stage I was looking at a profit that was at least 50 to 70% on return on invested capital. So the price that I paid to open the lips, I believe I was making about $1,000 in profit at that time, and I was considering should I partially close this position or not. I didn't. It ended up going down. Luckily, I closed it quickly when it went past my my stop loss, because it kept going down. I was still able to get a profit because volatility just expanded like crazy, but Not really happy with how I manage this position, but I have to say overall on the directional, I've really been performing well. So uh, so this is something that, yeah, I will keep investing on, and potentially I will make a transition more from volatility plays to directional plays depending on market conditions. So that's it. That's my recap for trading my $50,000 account. 1 month close in. I made about 3%. I'm happy with the return. I'm not happy fully with my performance and mainly with my product selection. I will consider better how to trade commodities or if to trade them at all. And also, one thing I need to take into more consideration is when to change from volatility strategies to directional strategies. Directional strategies performing really well, volatility strategies performed poorly. And the reality is that these things will balance themselves out. But I need to consider if certain market environments I should just decrease my allocation to volatility, increase my allocation to directional, or the other way around. Something is still a work in progress, but I'm considering it every day. So yeah, if you're interested in following along, please subscribe and like. Anything you'd like me to comment on, write down in the comments below. Yeah, cheers everyone.